Hello and welcome to a brand new episode of ETMarkets Smart Talk, a show where we talk about market trends, investing gyan, as well as the techniques to become an effective investor or a trader. Well, it's not easy to become a successful investor. It takes time, patience, and whatnot. And the kind of markets we are in, it's very important to know the golden rules of investing in the stock market. Well, to discuss this and much more, I'm going to be joined by a very special guest today. We have with us Manish Goel, who is the founder and director at Research and Rankings. Thank you so much, Mr. Goel, for joining us on ETMarkets.
Thank you, Tanya. Thank you for having me on the show. And thank you for the kind introduction.
Thank you. So let's start with the secrets, Mr. Goel. So what's the secret to successful investing, and how can one become a successful equity investor according to you?
So there's no secret to it. There are 4 or 5 key ingredients, I would say, one needs to take care.
Okay.
And first and foremost is the long-term attitude. So in the short run, markets are driven by sentiments and liquidity. But certainly in the long run, markets are driven by fundamentals.
Right.
So if you approach markets with a 1 year or 2 year or 3 year mindset, it could become difficult. If I may share some data point, between July 2020 till June 30th June 2021, markets delivered 45%, or Nifty went up by 45%.
Okay.
And in last 12 months, 1st July 21 till 30th June 2022, Nifty remained flat. In last 6 months, it was down by 10%.
Yeah. Right.
And during this 1 year period, in last 12 months, July 21 till June 30th June 2022, out of Nifty 500 stocks, as high as 65% of Nifty 500 stocks were down by 20 to 50%. And these are, mind you, very good quality businesses. Very good quality businesses. But because of this volatility, they were down by so much. Right. So if one really wants to approach market, it should be with minimum 5-year horizon. And if again we go by long-term averages of GDP growth in our country and Nifty growth in our country, GDP growth for 21 year comes more than 12%. Nifty growth for 21 year comes more than 14%, 13.5%, 14%. One can certainly expect that kind of compounding, or little more than that, in the range of 20%. But one needs to have patience. So approach market with a long-term mindset. Certainly, don't believe too much in the noise around you. Read, understand, learn, educate yourself to the extent possible, and you will certainly become a long-term investor. There will be a period of 45% growth, as I said, in a given year.
Yeah.
There'll certainly be a flat growth or negative growth here. But if you have a long-term 5-year, 7-year, 10-year horizon, 20% or in that range compounding is possible, which is, by the way, highest one can expect from any asset class.
Yeah, right. Absolutely. And how should one pick stocks amid volatile markets? I mean, are there any rules or any strategies that one should follow?
So there are again 4 or 5 rules one must follow. It is not only during volatile market. Okay. In general, I would say one should follow these rules. Okay. And first and foremost is don't compromise on quality.
Right.
Don't compromise on margin of safety. Right. If you compromise on quality, if you compromise on margin of safety, then it becomes difficult. But as long as you pick up a business with 15% or 20% top line growth, with 15% ROC, with all other key qualitative and quantitative parameters being in place, and we have done quite a few videos on our newly launched platform, Informed Investor, on that. So it is not very difficult to understand these 5 or 7 qualitative and quantitative parameters. Okay. Right? 3 or 4 qualitative parameters and 4 quantitative parameters, along with the right risk diversification and risk allocation strategy, one can certainly pick up very good quality businesses at a very reasonable rate during this time. So 3 or 4, the top line growth and bottom line growth and ROC, ROE being in place, along with promoter quality, along with sectoral growth, if one can do little bit of research and homework on that, and certainly a 5-year, 7-year horizon, it is more than possible to generate that kind of compounding, what I just said a while back, 20% or in that range. And these businesses, if you are picking up these good quality businesses during this time, what we have seen in last 12 months, markets are down, or at least Nifty 500 companies that are down anything between 20 to 50%. If you pick up these quality businesses, keeping in mind these qualitative and quantitative parameter, certainly compounding can be even a little higher. It can be a little higher. So quantitative and qualitative parameters, along with right sector allocation and risk diversification, makes an investor a successful investor. And compounding for the investments done during this period, one can expect a higher percentage compounding.
Okay, absolutely. And also, rupee is depreciating and is hitting fresh all-time lows on a daily basis, I would say. We are fighting with inflation. There are recession fears as well. So what are your expectations from the markets for the second half of 2022?
So, again, if you look at the data closely, last 3 months inflation data, in April, it was 7.8%. And data released just day before yesterday, it came down to as low as 7.01%. So there are going to be 5 or 6 key monitorables, I would say. Inflation subsiding being one of them. Along with that, we are expecting good pickup in the manufacturing activities. Okay. IIP data released today at 19.6% clearly shows the improvement. Okay. Then we are expecting markets to adjust to higher interest rate scenario. So in our country, we have already had 2 rate hikes, and in US Fed has announced 3 rate hikes. So markets have now learned, to adjust to higher rate interest rate scenarios. Okay. Now with this, if FII selling also reduces, which this month we have some bit of improvement from 40,000-50,000 crore every month, what it used to be for last so many months. This year in July so far it is at 6,000 crore. These 4 or 5 monitorables will be there for next 6 odd months. And if all of them, are manageable, and Nifty growth, what everybody is expecting, and so are we, in this year, FY23 will be in that 18% range, which will, for the FY23, Nifty EPS should be in that 830 to 850 range. Okay. If you give it 20 times or 22 times multiple, one can expect anything between 10 to 15% upside, even at the indices level, and manufacturing activity and inflation rate and higher interest rate and FII selling, if this trend continues, the reduced FII selling, these 4 or 5 monitorables and 18% EPS growth takes it to, as I said, 850 or in that range. One can expect anything between 15% upside in next 12 months from here. And this I'm saying broader markets. If you make right kind of investment, if you do what I said a while back, little bit of quantitative and qualitative research, then higher than that, even 20 odd percent or 25% in next 12 odd months one can expect. Right. So this is our expectation.
Okay. And also with interest rates on the rise, as you rightly mentioned, and global tensions as well, how, where do you see value in this kind of situation, and any sectors that are looking attractive, especially after the recent correction that we saw?
So, we are a long-term investor. We at R&R Research and Banking, recommend long-term investing to our clients all the time. So if again you look at the long-term trends, financial services has been the best performing sector. Okay. Followed by IT, followed by FMCG, followed by auto. If you look at the data, top 6 sectors, financial services, IT, FMCG, pharma and healthcare, auto and auto ancillary, paints and chemical contribute. These 6 sectors to put together contribute 50% of the market capitalization.
Right.
But then there comes a year like 2021, when sectors like energy, sectors like realty, they outperform all the other indices. Absolutely. Right? Sectors like capital goods, they outperform all the other indices. But we believe in a structural growth story. India is a structural growth story. We believe in that, and we want to continue investing in sectors which will support, or which have been supporting this structural growth story. So we are certainly not against investing in reality or infra or energy, right? These performing sectors, as and when that period comes, which 2021 it was. After so many years, 2021 was the year when these sectors outperform all the other indices.
Okay.
But given the fact we believe in a structural growth story of this country, I would certainly recommend that given the fact that contribution to these six sectors is as high as 50%, 50% allocation or little higher, should be towards these six sectors.
Okay.
And last 3 months, April, May, June, Nifty or the markets are down by 10%. But if you look at the data, FMCG, auto, banks, all these sectors have outperformed, all the other indices as well as Nifty. So we are focused on a structural growth story, and we know the fact that these sectors, contribute 50% of the market capitalization. We would certainly recommend investors to have 50% or more allocation toward these six sectors. And all the other sectors, look at it closely. If and when if there's an opportunity, why not? One can always, have some allocation. I would say lower allocation even towards other sectors. Sectors like reality, which after so many years, they perform for a year, 2 year. So cyclical in nature. Basically those sectors, energy or reality are more cyclical in nature. So even those sectors one can consider, but not a very high percentage.
Okay, absolutely. And lastly, Mr. Goel, before we let you go, your advice for all the new investors, I mean, any hacks to manage the money, any mistakes that they should avoid, especially at this point in time?
So, Tanya, I would like to, mention 4 focus areas here, which we have developed over so many years. So as a firm, we have been around for more than a decade.
Yeah.
And, we have been managing thousands of families, their wealth. So we have developed 4 focus areas. These 4 focus areas will certainly help, any new investor as well as a seasoned investor.
Okay.
And the first one is, stay away from 6 financial diseases. And first and foremost is the leverage. So we have seen, how people lose money, if they take leverage or if they invest borrowed capital.
Right.
Then over or under diversification. One should certainly stay away from over or under diversification. One should certainly, not consider price everything. Price is important. Margin of safety is important, but price is not everything. As I said, qualitative and quantitative parameters are equally important.
Absolutely.
Right. One should certainly, allocate some time towards understanding the businesses, he or she is investing into.
Right.
And there comes the excessive churning. If there is a year, what we have seen last 12 months, Nifty has not done much, or rather in 6 months, it is down by 10%. One should not, resort to over churning or excessive churning. Stay put. If you know the quality of businesses, stay put. So this is the first focus area where we recommend clients to stay away from these financial diseases. Then the second one talks about all years are not alike. We discussed last 21 years average for Nifty. Nifty CAGR for so many years comes 13.95%. Against this, if you see last 12 months, there was no return delivered. The last 12 months before that, July 2020 to June 2021, it moved up by as high as 45%. So all years are not going to be alike. But then this is the fun. If there is a negative growth year or flat growth year, if you have, belief in the India's growth story, then certainly allocate more, as long as you have liquidity, available. And if liquidity is not available, but you have not taken leverage, just stay put. There'll certainly be a year when 40% or 100% or 80% in a year, markets will deliver, your portfolio will deliver, as long as you have bought good quality business. So the second focus area is stay, all the years are not aligned. Then the third one is in the short run, markets are driven by sentiments and liquidity, and in the long run, markets are driven by fundamentals.
Right.
This is something we teach to all our customer clients all the time, that if there is a period when it has moved up by 50% or 100% in a given year, don't read too much into it. 50% or 100% is just not possible. Likewise, minus 10% or flat, just don't be too worried about it.
Yeah.
Look at 5-year horizon, it will settle down, because in the long run, fundamentals will prevail.
Right.
And the last one is cherish a few, which is stay away from over diversification. Right. Stay away. If you have bought a few businesses, like we take care of our kids and we expect them to take care of us, when we grow old, certainly we can expect these businesses to, give us a good upside if we stay put for a decade, for 2 decades, for a much longer period, as long as possible. And these businesses, if you know enough about them, and they deliver this kind of 20% or little more than 20% compounding if possible for you, then it will certainly give you a good retirement surplus. So cherish a few and know or study as much as possible those few and give it time. So these are the 4 focus areas. We keep talking about these focus areas all the time in every platform. And I'm very proud to say that a lot of investors have taken advantage of it. And now they know that investing doesn't have to be stressful all the time. It can be stress-free investing, and still you can create wealth with the help of these 4 focus areas.
Absolutely. Golden words coming in from you on that wonderful note. Thank you so much, Mr. Goel, for taking the time out and sharing your valuable thoughts and being with us here on ET Markets today. Thank you so much.